Classical chart analysis. Chartists study market action, trying to identify recurrent price patterns. Their goal is to profit from trading when patterns recur. Most chartists work with bar graphs showing high, low, and closing prices and volume. Some also watch opening prices and open interest. Point-and-figure chartists track only price changes and ignore time, volume, and open interest. Classical charting requires only a pencil and paper. It appeals to visually oriented people. Those who plot data by hand often develop a physical feel for prices. Computers speed charting at a cost of losing some of that feel. The biggest problem in charting is wishful thinking. Traders often convince themselves that a pattern is bullish or bearish depending on whether they want to buy or to sell. Chart patterns reflect the tides of greed and fear among traders. This book focuses on daily charts, but you can apply many of its principles to other data. The rules for reading weekly, daily, hourly, or intraday charts are very similar. Each price is a momentary consensus of value of all market participants expressed in action. Each price bar provides several pieces of information about the balance of power between bulls and bears. The opening price of a daily or a weekly bar usually reflects the amateur's opinion of value. They read morning papers, find out what happened the day before, and call their brokers with orders before going to work. Amateurs are especially active early in the day and early in the week. Traders who researched the relationship between opening and closing prices for several decades found that opening prices most often occur near the high or the low of the daily bars. Buying or selling by amateurs early in the day creates an emotional extreme from which prices recoil later in the day. In bull markets, prices often make their low for the week on Monday or Tuesday on profit-taking by amateurs, then rally to a new high on Thursday or Friday. In bear markets, the high for the week is often set on Monday or Tuesday, with a new low toward the end of the week on Thursday or Friday. The closing prices of daily and weekly bars tend to reflect the actions of professional traders. They watch the markets throughout the day, respond to changes, and become especially active near the close. Many of them take profits at that time to avoid carrying trades overnight. Professionals, as a group, usually trade against the amateurs. They tend to buy lower openings, sell short higher openings, and unwind their positions as the day goes on. Traders need to pay attention to the relationship between opening and closing prices. If prices closed higher than they opened, then market professionals were probably more bullish than amateurs. If prices closed lower than they opened, then market professionals were probably more bearish than amateurs. It pays to trade with the professionals and against the amateurs. Efficient markets, random walk, and nature's law. Efficient market theory is an academic notion that nobody can outperform the market because any price at any given moment incorporates all available information. Warren Buffett, one of the most successful investors of our century, commented, "I think it's fascinating how the ruling orthodoxy can cause a lot of people to think the earth is flat. Investing in a market where people believe in efficiency is like playing bridge with someone who's been told it doesn't do any good to look at the cards." The logical flaw of efficient market theory is that it equates knowledge with action. People may have knowledge, but the emotional pull of the crowd often leads them to trade irrationally. A good analyst can detect repetitive patterns of crowd behavior on his charts and exploit them. Random walk theorists claim that market prices change at random. Of course, there is a fair amount of randomness or noise in the markets, just as there is randomness in any other crowd milling around. An intelligent observer can identify repetitive behavior patterns of a crowd and make sensible bets on their continuation or reversal. People have memories. They remember past prices, and their memories influence their buying and selling decisions. Memories help create support under the market and resistance above it. Random walkers deny that memories of the past influence our behavior in the present. As Milton Friedman has pointed out, prices carry information about the availability of supply and the intensity of demand. Market participants use that information to make their buying and selling decisions. For example, consumers buy more merchandise when it is on sale and less when prices are high. Financial traders are just as capable of logical behavior as homemakers in a supermarket. When prices are low, bargain hunters step in. A shortage can lead to a buying panic, but high prices choke off demand. Nature's law is the rallying cry of a clutch of mystics who oppose random walkers in the financial markets. Mystics claim that there is a perfect order in the markets, which they say move like clockwork in response to immutable natural laws. R.N. Elliott even titled his last book, Nature's Law. The perfect order crowd gravitates to astrology and looks for links between prices and the movements of the planets. Most mystics try to hide their astrological bent, but it is easy to draw them out of a shell. Next time someone talks to you about natural order in the markets, ask him about astrology. He will probably jump at the chance to come out of the closet and talk about the stars. Those who believe in perfect order in the markets accept that tops and bottoms can be predicted far into the future. Amateurs love forecasts, and mysticism provides a great marketing gimmick. It helps sell courses, trading systems, and newsletters. Mystics, random walk academics, and efficient market theorists have one trait in common. They are equally divorced from the reality of the markets. Extremists argue with one another, but they think alike.